In order to stop exploitation of consumers, the government has made sure that there's several consumer protection organisations looking out for our back. In this video, we're going to be looking at 5 in particular. Make sure you leave a like and subscribe for future related videos. In this video, we're going to look at why the financial services consumers need protection, and we're going to delve into what happened during the 2007 financial crash. We're also going to look at 5 different organisations set up to help protect consumers. So why do financial services consumers need protection? Well, the causes of the 2007 financial crash, otherwise known as the credit crunch, were that banks lent money to people who were likely to be unable to pay. And therefore that meant that many people defaulted on their loans. They were unable to pay, and therefore the banks did not get the money back that they were owed. Banks used money from the retail business, current accounts, savings, etc., to pay losses made by their investment operations. It used to be that banks had retail business and investment operations all under one roof. So that means essentially that if they made any losses from investments, then they could use their retail business to pay for any losses. Nowadays, however, the government has made sure that there's legislation in place so that the investment operations and the retail business are separate. The UK market was dominated by very large banking organisations that many considered too big to fail. Now that, of course, was not the case. There were a number of banks who either failed entirely or had to be bailed out by the government. That was an issue, of course, because many people just assumed that they'd never fail. So many of the consumer protection measures that are now in force were set up as a direct result of the global financial crisis. So, what is there in place to protect consumers? Well, organisations that exist to protect consumers in the financial industry are as follows: the FCA, the PRA, FOS, FSCS, and the CMA. You may wish to pause the video at this point just to check if you know what these acronyms stand for. So, the FCA stands for Financial Conduct Authority. The FCA make financial markets work well so consumers get a fair deal. They report directly to His Majesty's Treasury, and as I said, the main thing about this organisation is they try and ensure that markets work well, so we as consumers get a good, fair deal. The PRA, on the other hand, stands for Prudential Regulation Authority. They are responsible for the regulation of banks, building societies, credit unions and insurers. They try and reduce the risk that these banks and building societies, etc., expose themselves to. That means that, of course, less risk means less potential for going bust. The FOS, on the other hand, stands for Financial Ombudsman Service. The FOS sorts out complaints between financial businesses and their customers. Decisions made by the FOS are legally binding on the firm being complained about. However, they are not legally binding on the consumer, and if the consumer is not happy with the settlement that the Financial Ombudsman Service has come to, then they can take the issue to court in the hope of pursuing further compensation. The FSCS stands for Financial Services Compensation Scheme. It will repay customers their deposits if the provider is unable to do so. That essentially means that if a bank or building society or other financial institution goes bust and is unable to pay back customer deposits, then the FSCS will compensate that customer up to £85,000 per person. Of course, in a joint account, it would be 2 times 85,000, adding up to £170,000 worth of compensation. It's a key point to remember that with premium bonds, the maximum you can invest at present is £50,000. So although the FSCS covers premium bonds, they're an exception to the rule in that the maximum compensation you can get through premium bonds is £50,000. The CMA is short for Competition and Markets Authority. Now, this organisation works to promote competition between providers for the benefit of customers. Of course, if there's competition between providers, that essentially means that prices, savings rates, etc., will be more favourable. So the prices of loans, the interest rate charged on loans, will have to remain competitive with other providers, whereas the same thing goes for savings rates. Savings rates will also have to remain competitive. So, 3 multiple choice questions to assess your understanding of this topic. Under normal circumstances, the Financial Services Compensation Scheme, FSCS for short, protects the savings of an individual up to what maximum amount? Is it A, £20,000 per person per provider, B, £50,000 per person per provider, C, £85,000 per person per provider, or D, £100,000 per person per provider? The answer to question 1 is C. The maximum is £85,000 in the UK. Question number 2. Which of the following is responsible for ensuring that all financial services providers operate in a way that benefits consumers and the market as a whole? Is it A, the Financial Conduct Authority, B, the Financial Policy Committee, C, the Financial Services Compensation Scheme, or D, the Prudential Regulation Authority? The answer to question 2 is A. This is a key role of the FCA. Question number 3. Which of the following statements about the Financial Ombudsman Service, FOS, is true? Is it A, that consumers are charged for the service if their complaint is rejected by the FOS? B, decisions made by the FOS are legally binding on the firm being complained about? C, the maximum compensation award that can be made is £100,000, or D, the service is funded directly by the government and through private sponsorship? The answer to question 3 is B. Decisions made by the FOS are legally binding on the firm being complained about. They are not, however, legally binding on the complainant, who may take further action through the courts if they wish. Give that banner a smash to play the next video in the series, but not before you're subscribed.